$6 trillion disappeared in less than 1 hour. Not over days, not over weeks, in minutes. Gold and silver markets collapsed with speed that left most participants unable to react. This was not normal volatility. This was not a correction. This was forced liquidation at scale. The charts tell the story clearly. Gold dropped from $2,650 to $2,520 in 40 minutes. Silver fell from $32.50 to $29.80 in the same window. The speed was extreme. The volume was massive. And the timing was synchronized across all precious metals markets simultaneously. Most people watching assumed this was a glitch, a technical error, a fat finger trade. It was not. This was the unfolding of a mechanical process that began weeks earlier. The crash was not random, it was predictable, for those who knew where to look. Leverage is the foundation of modern markets. It allows positions far larger than available capital. It magnifies returns when trades work, and it destroys accounts when they do not. Precious metals markets operate on leverage ratios that would terrify most people if they understood the numbers. A standard futures contract allows control of 100 ounces of gold with roughly $10,000 in margin. That is 20-to-1 leverage. A 5% move against the position wipes out the entire account. When volatility spikes, that 5% move can happen in minutes. Silver leverage is even more extreme. A single silver contract controls 5,000 ounces. Margin requirements allow leverage exceeding 25-to-1 in some cases. Small price moves create massive profit or loss. And when the move is large and fast, accounts are liquidated before traders can respond. This is not theory. This is mechanical reality. And on that day, the mechanism activated across the entire market simultaneously. The liquidation cascade works like this. Prices drop slightly. Leverage positions hit margin requirements. Brokers issue calls. If capital is not added immediately, positions are closed automatically. That forced selling pushes prices lower, which triggers more margin calls, which forces more selling. The cycle accelerates until leverage is purged from the system entirely. This process is well understood, but it is rarely observed at this scale and speed. What made this event different was the synchronization. Gold, silver, platinum, palladium, all crashed together. This was not isolated to one metal. This was systematic. When all precious metals move identically, it signals a common cause. That cause was not within the metals themselves. It was external. It was the dollar, specifically the US dollar index. The dollar spiked hard that morning, from 106.2 to 107.8 in less than 2 hours. This was not gradual strength. This was a surge. And precious metals have an inverse relationship with dollar strength. When the dollar rises sharply, metals fall. Always. But the speed of the dollar move was unusual. Currency markets rarely move this fast without a specific catalyst. That catalyst was Federal Reserve commentary, not an official statement, not a policy announcement, just remarks from a single Fed official suggesting rates might stay higher for longer than markets expected. This is how modern markets operate. A single comment can shift trillions in value instantly. Because markets are not driven by fundamentals anymore. They are driven by liquidity expectations, and liquidity expectations are driven by interest rate policy. Higher rates make holding non-yielding assets like gold less attractive. Higher rates strengthen the dollar. Higher rates tighten financial conditions. All of these factors pressure precious metals simultaneously. When rate expectations shift suddenly, metals react violently. But there was another factor. China. Industrial data from China had been weakening for weeks. Manufacturing indices declining. Import numbers falling. These data points matter for silver especially, because silver is not just a monetary metal, it is an industrial metal. And China consumes nearly half of global industrial silver supply. When China's economy slows, silver demand weakens. When demand weakens, prices fall. This relationship is direct. And the data released that week confirmed the slowdown was accelerating. Factory output dropped, Construction activity declined. Electronics production fell. These numbers did not surprise economists, but they surprised markets because markets had been pricing in a recovery. Positioning reflected optimism. When the data contradicted that optimism, positions unwound fast. Then came the political trigger. News broke that U.S. government shutdown risks were rising. Budget negotiations had stalled. Deadlines were approaching. The probability of a shutdown increased materially within hours. Government shutdowns create uncertainty. Uncertainty reduces risk appetite. When risk appetite falls, leveraged positions get cut. The shutdown risk alone would not have caused a crash, but combined with dollar strength, Fed hawkishness, and China weakness, it became the final catalyst. Fear is a multiplier in leveraged markets. When conditions are stable, fear is manageable. But when multiple risk factors align, fear compounds. Traders do not wait to see what happens. They exit immediately. And when everyone exits simultaneously, liquidity vanishes. Liquidity is the ability to transact without moving price significantly. In normal conditions, large orders can be filled with minimal slippage. But when liquidity disappears, even small orders move markets violently. And during a liquidation cascade, liquidity does not just decrease, it evaporates entirely. The order book that morning showed the collapse in real time. Bid depth fell from thousands of contracts to dozens. Ask prices gapped higher while bid prices plunged lower. The spread between buying and selling widened from pennies to dollars. This is the signature of a liquidity crisis, and in that environment, the only participants able to transact were those with deep capital reserves. Institutions, market makers, sovereign entities, retail traders were locked out, their stops were hit, their margins were called, their positions were closed at the worst possible prices. This is how wealth transfers during crashes, not from markets to nowhere, from those forced to sell to those with capital to buy. The $6 trillion in value did not vanish. It moved from overleveraged positions to patient capital, from weak hands to strong hands, from retail to institutional. Gold dropped harder than most expected, but silver moved twice as far on a percentage basis. This is the multiplier effect. Silver is more volatile than gold by nature. Its smaller market size means price swings are amplified. A 5% gold move typically corresponds to an 8 to 10% silver move. This volatility attracts speculators, but it also destroys them during liquidations. The same leverage that creates opportunity in stable markets creates devastation in chaotic ones, and that day, chaos was total. The gold-silver ratio spiked from 82 to 87 in that single hour. This ratio measures how many ounces of silver equal 1 ounce of gold. When it rises, silver is underperforming. When it falls, silver is outperforming. The spike confirmed that silver was being dumped harder than gold. But why? The answer lies in positioning. Silver attracts more speculative leverage than gold. Retail traders favor silver because the lower price per ounce allows larger position sizes. This creates a concentration of weak hands, and weak hands break first under pressure. Now let us examine what happened after the crash. Markets do not stay broken forever. Liquidity eventually returns. Prices stabilize. The question is at what level? Within 3 hours, gold had recovered half its losses. Silver recovered less. This divergence is typical. The same volatility that amplifies silver's downside limits its recovery speed. The metal moves fast in both directions, but rebounds require buying pressure, and buyers were cautious after such violent selling. By the end of the day, gold closed down 3.2%. Silver closed down 5.8%. These are significant moves, but they were far smaller than the intraday extremes. This means bargain hunters entered, they bought the dip, they absorbed the selling, and they stabilized the market before further damage occurred. Who were these buyers? Not retail traders. Retail was wiped out during the cascade. The buyers were institutions with dry powder, sovereign wealth funds, central banks, large commodity funds, entities that view crashes as opportunities rather than disasters. This is the fundamental asymmetry of modern markets. Those with leverage are fragile. Those with capital are anti-fragile. Volatility destroys the former and enriches the latter. The system is designed this way. Whether intentionally or not is irrelevant. The outcome is the same. One chart could have warned attentive observers before this happened. The chart most people ignored. It was not a precious metals chart. It was the US dollar index weekly chart. That chart showed a clear reversal pattern forming 3 weeks prior to the crash. The dollar had been declining for months, weakening steadily. This decline was the foundation for the precious metals rally that preceded the crash. As the dollar fell, gold and silver rose. The inverse correlation held perfectly, but the weekly chart showed the decline was ending. A double bottom formed at 104.5, support held twice. Then a reversal candle appeared, a hammer pattern with high volume. This signaled that sellers were exhausted and buyers were stepping in. The next week confirmed with a strong bullish close. Technical traders watching this chart knew the dollar was bottoming. And if the dollar was bottoming, metals were topping. The logic was simple. But most metals traders were not watching the dollar chart. They were watching gold and silver. And those charts still looked bullish until they did not. This is the danger of single market focus. Markets do not operate in isolation. Everything is connected. Currencies, rates, equities, commodities. When one major market shifts, others react. Ignoring those connections creates blind spots. And blind spots are where losses happen. The Federal Reserve's role in this cannot be overstated. Central bank policy drives everything. When the Fed signals tightening, markets react. When they signal easing, markets react differently. The problem is that Fed signals are often unclear, intentionally so. Central banks do not want to cause market disruptions. They communicate carefully. They use vague language. They avoid commitments. But markets demand clarity, so they interpret every word, every pause, every tone shift. And sometimes they interpret wrong. That morning, a Fed official made comments about inflation persistence. The remarks were not dramatic, but they suggested that rate cuts might be delayed. Markets had been pricing in cuts within months. Suddenly, that expectation was challenged. Futures repriced instantly, and that repricing flowed directly into precious metals. This is the transmission mechanism. Fed expectations drive interest rates. Interest rates drive the dollar. The dollar drives precious metals. The chain is direct, and when the first link moves sharply, the last link snaps. China's economic data compounded the problem specifically for silver. While gold is primarily monetary, silver straddles two categories: monetary and industrial. This dual nature creates unique vulnerability. When industrial demand falls, half of silver's support disappears. Unlike gold, silver cannot rely purely on safe haven flows. It needs industrial consumption to maintain price levels. And China's slowdown directly threatened that consumption. The numbers were stark. Chinese silver imports fell 18% year over year in the most recent data. Electronics production declined. Solar panel installation slowed. These are silver's primary industrial uses. When they weaken, silver's fundamental support weakens with them. Markets had been ignoring this weakness, focusing instead on monetary demand, on inflation fears, on currency debasement narratives, all valid but incomplete. The industrial side matters, and when it cracked, the market repriced violently. Government shutdown fears added psychological pressure at the worst moment. Markets hate uncertainty. Political dysfunction creates uncertainty. Even if a shutdown's economic impact is temporary, the fear of it is immediate. Traders watching budget negotiations saw deadlock. They saw politicians unable to compromise. They saw deadlines approaching without resolution. This created a risk-off impulse, and in risk-off environments, leverage positions are the first casualty. The shutdown ultimately did not happen. A last-minute agreement was reached, but by then the damage was done. The crash had occurred. Positions had been liquidated. Accounts had been wiped out. The resolution of the political crisis could not undo the market crisis it had contributed to triggering. This reveals an important truth about modern markets. Perception matters more than reality. The fear of a shutdown caused more damage than an actual shutdown would have, because fear is immediate. Reality takes time, and markets move at the speed of fear, not fact. What happens after crashes like this? History provides clear patterns. Liquidation events typically create bottoms, not immediately, but within weeks, because forced selling exhausts itself, and once it does, value attracts buyers. The crash in March 2020 followed this pattern. Gold dropped from $1,700 to $1,450 in days. Silver fell from $18 to $12. Liquidation was brutal, but within 2 months, both metals were making new highs. The forced selling created opportunity for those with capital and courage. The crash in 2013 showed similar dynamics. Gold fell from $1,900 to $1,200 over several months. Each sharp drop was a liquidation event. Each one created a temporary bottom, and each one transferred metal from weak hands to strong hands. The pattern is consistent. Leverage creates fragility. Volatility triggers liquidation. Liquidation creates opportunity. Those who understand this cycle profit. Those who do not become the liquidity that others profit from. This crash was no different in mechanism, only in speed. The principles remain the same. Paper positions were destroyed. Physical metal changed hands. Wealth transferred from those forced to sell to those able to buy. The $6 trillion in value did not disappear into thin air. Value cannot be destroyed, only transferred. The crash represented the largest single-day wealth transfer in precious metals markets in years. From overleveraged speculators to institutional buyers, from retail stops to institutional bids. This is not conspiracy. This is mechanics. Markets are designed to extract wealth from the impatient and transfer it to the patient, from the leveraged to the capitalized, from the emotional to the systematic. The design is not hidden. It is visible to anyone willing to observe. What should have been learned from this event? First, leverage is a weapon that cuts both ways. It amplifies gains, but also amplifies losses. In volatile markets, leverage is usually the cause of destruction, not the solution to opportunity. Second, correlation matters. Precious metals do not trade in isolation. The dollar matters, interest rates matter, China matters, politics matters. Ignoring these factors because they are not directly related to gold or silver is a critical error. Third, liquidity is not guaranteed. In normal times, markets feel liquid. Orders fill easily. Stops execute as expected. But during stress, liquidity vanishes. And when it does, prices gap violently. Stops do not protect. They just lock in losses at the worst possible moment. Fourth, institutions have structural advantages. They have capital reserves. They have access to liquidity. They have information flow. Retail traders have none of these. Competing on the same playing field means accepting massive disadvantages. Fifth, crashes create opportunities for those prepared. If you have capital when others are forced to sell, you can buy assets at discounts, but only if you are not overleveraged yourself, only if you have kept reserves, only if you have maintained discipline. The metals market will experience more events like this, perhaps not at this scale, perhaps not this fast, but the mechanism remains intact. Leverage will build, volatility will spike, liquidation will occur, wealth will transfer. Understanding this pattern does not prevent losses, but it allows positioning that survives volatility instead of being destroyed by it. It allows preparation instead of panic. It allows opportunity instead of disaster. This is educational observation of market mechanics, not advice, not prediction, just pattern recognition based on documented history. The patterns repeat, the mechanism persists, the outcome is consistent. $6 trillion moved in 1 hour, from those who were forced to act to those who chose to act. That is the difference between survival and destruction in modern markets.